There's a million people on YouTube, social media, and who you spend time with have an opinion on how exactly to invest and save for retirement. But how do the wealthiest 1% actually do it? This is what I know. We all have behaviors, habits, beliefs, ideas, or views that, if left unchallenged, easily sabotage our success. For example, many people are great at career success, but poor with family or financial life success. They have a history of making slightly suboptimal decisions, sometimes misplacing priorities, procrastinating, or overspending. Many people I meet take advice from entirely the wrong people, like a friend down the pub who's an expert in investing and claims to know exactly how the markets are going to always do in the future. I've spent the last 20 years providing specialist financial counsel and sage investment guidance to thousands of successful professionals and family leaders who earn in excess of $500,000 per year, and ensuring they transition through the different phases of life comfortably. And the top 1% all have one thing in common. They don't chase complicated strategies. Instead, they follow a surprisingly simple approach that anyone can replicate. So in this video today, I'm going to break down exactly how the wealthiest people structure their finances, where the money goes, how they diversify their investments, and the steps that you can implement right now to join them in retiring well. Let's look at a real client we work with. We're going to call him Andrew. He's 48. He earns about $750,000 per year and lives in Dubai. His wife is also very successful, running her own consulting business, and they have 2 kids studying internationally. Whilst their financial situation spans multiple countries, they maintain a relatively low wealth profile that are described as perhaps the millionaire that lives next door. Quietly, they built a net worth of just over $3.85 million with a clear retirement goal of stopping work before 55. Here's exactly how that $3.85 million breaks down. Primary residence, about $1.6 million, fully owned. Investment properties, $600,000 in a London flat that's rented out. Pension and retirement accounts, around $700,000 in various pension plans accumulated from previous employers in the UK, taking advantage of a tax-efficient growth. Stocks and investment accounts, $800,000 diversified across global stock markets. No speculation, just steady, systematic, evidence-based investing. Cash holdings, approximately $150,000, giving them flexibility and security during downturns. As you can see, their wealth isn't randomly assembled. It's deliberately balanced between short-term security, cash, income generation, property, long-term growth, pensions, global stocks, and personal comfort, lifestyle, their home. Each portion serves a clear, intentional purpose. You should have this yourself, a clear, visual breakdown of your own net worth, not just the total figure, but exactly how it's all allocated. If you don't, speak to a fiduciary to help you out. When you clearly define each asset's role, you remove confusion, can make smarter decisions, and build a more stable financial future. And just before we move on, if you want to map out your own net worth the way that high net worth individuals do, we put together a free resource for you. It's called the Invest Like the 1% Playbook, and it walks you through exactly how to structure your wealth properly. You can grab it using the link in the description below. Now, let's talk specific about how Andrew's pensions and investments are structured. You might think someone with his wealth and international lifestyle would have an incredibly complex, exciting portfolio, but here's exactly how it's broken down. 80% global stocks, 20% bonds. As you can see, the core of his retirement strategy isn't flashy at all, and it's not built upon hedge funds, private equity, gold, alternatives, crypto speculation, or chasing the next unicorn startup, but instead the bulk of his wealth is allocated to globally diversified, low-cost index funds and high-quality bonds. Simple, evidence-based, and time-tested. The remainder of the money that's in bonds reduces the volatility and provides a war chest that enables him to weather any future economic storm for up to 5 years. Why? Because the data is very clear on this. Over the long term, this kind of highly disciplined, low-cost investing into the great companies of the world tends to reliably and more certainly outperform the majority of complex strategies. And once you factor in taxes, fees, and emotional decision-making, the gap between the two widens even more. The wealthiest people aren't looking for thrills. They're looking for outcomes. And the outcome they care about most is increasing their family's future financial purchasing power to fund the ideal future that they want. This represents peace of mind and family security. They resist the urge to over-engineer their portfolios. Complex does not mean better, it just means much harder to monitor, probably more expensive, harder to tax manage, and to stick with. Make globally diversified, low-cost investing the foundation of your retirement strategy. Then, if you want to scratch the itch, something more active, such as venture capital, angel investing, or thematic ETFs, treat that like the seasoning, but definitely not like the main course. The wealthiest people don't avoid risk altogether, they just don't want to bet their houses on it. When it comes to banking, cash, and costs, he applies the same rules that he uses across his entire financial life. He keeps it simple and he keeps it smart. Yes, he does have a private banking account, but it wasn't chosen for the name, the complex discretionary fund management services, or the marble floored branches. It was a calculated decision. He did thorough due diligence going in. He knew exactly what he was getting, exactly what he was going to pay, and exactly what value he expected in return. Outside of that, no clutter. He doesn't have 10 different banking or trading accounts across different apps. He's not chasing sign-up bonuses or juggling currencies for sport. He holds around 6 months' worth of living expenses in cash, split between high-interest savings and ultra-low-cost money market funds. It's not glamorous, but it is highly effective. What we see time and time again is the truly wealthy is this. They're much more interested in efficiency than status and prestige. They understand that high fees, hidden foreign exchange fees, charges, and overly complicated products quietly erode their wealth over time. And they've learned, often from painful experience, that exclusive doesn't always mean better or superior. Real wealth prefers clarity over clutter, because at their level, preserving wealth matters just as much, if not more, than growing it. Keep your banking structure lean. Avoid accounts that look premium but hide high fees or unnecessary costs. Always know exactly what you're paying, because the truth is this. Keeping your costs low and your setup very simple will do more to protect and compound your wealth than chasing the illusion of elite, high-status financial services. So why do the wealthiest people invest this way? It's not luck. It's not because they have access to some secret playbook that the rest of us don't. It's because they follow a proven pathway with deliberate logic. They know that real wealth is built through companies and bricks, the stock market and property. They focus on optimization because small course corrections such as paying attention to aggregated costs, the difference between Lombard loans and mortgages, the reliability and certainty of expected future returns, this will all combine to prevent drift and make a profound impact when compounded over time. They deeply appreciate that there's much more to great financial life management than simply investment returns. They consider carefully about overall structure, tax, family well-being, insurance, wills, powers of attorney, the rising generation, the future, family risk, good governance structures, and they run what-if scenarios. In fact, there are actually 9 domains within family wealth, and investing wisely and sagely is just one of them. And very importantly, they follow what the up-to-date, peer-reviewed academic evidence says actually works. No noise, no hype, no snake oil, no shortcuts. It's all boring and intentional. Because most people just won't win the lottery. Most people won't strike it rich overnight. But almost anyone can build meaningful wealth slowly and steadily by using the income they earn day by day and making smart, repeatable decisions. And the strategy you've seen today, that's exactly how the top 1% do it. They block out the hype, they ignore the hot tips and the complicated trends. They invest consistently in proven, productive assets, stocks, and property. They relentlessly prioritize low fees and tax efficiency. And above all, they embrace simplicity. Because when it comes to building a retirement, you don't just fund, but actually enjoy. Boring is exactly what works. So now you know exactly how the wealthiest 1% save for retirement, but understanding these strategies is just the first step. Actually following through requires knowing the rules they live by. So check out this video next where I share the 10 investing rules high net worth individuals always follow so you can start building wealth the right way today.